So, moving to question number 3 in the paper. Anora Private Limited prepares its financial statements in compliance with Sri Lanka Accounting Standards LKSs, SLFRSs. The financial year of the company begins on 1st April each year and ends on 31st March the following year. Some of the events of the company that happened with the COVID-19 pandemic are listed below. Part 1, Anora had to close down its marketing and manufacturing operations from 16th March 2020 to 15th May 2020 as a result of the curfew imposed by the government. Due to COVID-19 outbreak, 15 million rupees worth of raw material stock that prevailed as at 16th March 2020 was found to be obsolete, non-usable on 16th May 2020 due to the said close down. The financial statements of the company for financial year 19 and 20 were authorized for issue on 2nd July 2020. The normal production capacity of Anora's manufacturing plant is 320,000 units per month, and the fixed production overheads per month are 80 million rupees. Due to the pandemic, the actual production in March 2020 was limited to 176,000 units. Third one, due to no physical usage, Anora did not charge depreciation for property, plant and equipment during the close down period. The company depreciates its property, plant and equipment using the straight line method. It also did not perform an impairment test to assess the recoverability of the carrying value of property, plant and equipment as at 31st March 2020. The estimated value of the sales drop during the closed down period is 2,420 million rupees for the financial year 2021. The resulting estimated contribution loss due to the sales drop is 356 million rupees. The management of the company expects to make a full provision for the estimated contribution loss in financial year 19 and 20 required. Advise the management of Anora on the accounting treatment for each of the matters referred to in 1, 2 and 3, 1, 2, 3 and 4 above for the financial year ended 31st March 2020 in accordance with LKSs, SLFRSs. Right. Now it says the financial year of the company begins on 1st April. 1st April ends on 31st March. Ends on 31st March. Now, first one says the company has closed down its marketing and manufacturing operations from 16th March 2020 to 15th May 2020 as a result of the curfew imposed by the government. Due to COVID-19 outbreak, 15 million rupees worth of raw material stock that prevailed at 16th March 2020 was found to be obsolete, non-usable on 16th May due to the said closed down. The financial statements of the company for financial year 1920 were authorized for issue on 2nd July 2020. Right. 16th May and 2nd July. Now, which accounting standard is a question given from? It's partly from LKS2 and partly, especially, it is from LKS 10, events occurring after the reporting period. Now, the financial statements have been authorized for issue for publication purpose on 2nd July 2020, and we found that the inventories have become obsolete. They are no longer saleable or they are no longer usable on 16th May 2020. But remember, it's very important to remember the fact that the inventories that are found to be obsolete on this date are the inventories which existed on the reporting date 31st March. So, we know that as per case 10, we learned two events, basically adjusting and non-adjusting. That is our convenience. I mean, the names we are using for our convenience, but what do you mean by adjusting? Adjusting events are the events that are indicative of conditions that existed on the reporting date. So, we had inventories on the reporting date and they are supposed to be recognized in the statement of financial statements at the lower of cost and NRV. But until such time, we reopened our showrooms and resumed our distribution activities, we were not aware of the fact that the inventories were obsolete and they were no longer usable. So, you being aware of the inventories are no longer usable and saleable on 16th May 2020 provides informations and evidences to the condition of the existed inventories on 31st March 2020 have been either obsolete or the inventories are required to be written down from cost to NRV. So, that condition has existed on the reporting date, but we got to know that only on 16th May 2020. So, this is an event that provides evidences and conditions and informations to the conditions that existed on the reporting date. It is not just an indicative of conditions that arose after the reporting date, no, that provides informations and evidences to the conditions that existed on the reporting date. So, you need to get back to the reporting date and take inventories and you need to write it down from whatever the value which is recorded them at now and to net realizable value NRV. So, that loss has to be recognized to profit and loss for the period ending on 31st March 2020. What is the value? It is 15 million rupees. You need to recognize 15 million rupees as a loss in the profit and loss for the year ending 31st March 2020. So, what should be the matters to be highlighted? So, you need to say that the inventories having been found to have been obsolete by 16th March or rather on 15th May 2020 has to be an event that provides evidences and informations to the conditions existed on the reporting date and should be adjusted for the year ending 31st March 2020. So, accordingly, that inventories that existed on the reporting date require to be written down from the cost to NRV. So, the loss is going to be 15 million rupees and immediately recognize it to the profit and loss for the year ending 31st March 2020. So, the inventories have to be almost like being de-recognized, that particular inventories, why they are no longer usable. So, that is what you need to say in part 1 of question number 3, but also for your requirement, let me also read out the examiner's answer. Question number 3, part 1, raw material stock worth 15 million rupees has become obsolete, non-usable due to close down of the manufacturing plant. Since the close down began on 16th March 2020 and obsolete items were identified on 16th May 2020, this is an event after the reporting period. The financial statements have been approved on 2nd July 2020. This provides evidence of conditions that existed at the end of the reporting period, and this is an adjusting event in the financial year 1920. Based on that, inventory provision of 15 million will be charged to profit or loss. Right. Question number 3, part 2. The normal production capacity of Anora's manufacturing plant is 320,000 units per month, and the fixed production overheads per month are 80 million rupees. Due to the pandemic, the actual production in March 2020 was limited to 176,000, and that's exclusively from LKS 2. Determining the cost of inventories, allocation of overheads, and overheads allocation does not become an issue and a hassle if it is variable overheads. We know variable overheads are commensurate to the number of units of production. The bigger the number of items you manufacture, the bigger and higher the amount of variable overheads. It changes, it varies in accordance with the quantity, whereas the fixed overheads will be completely different. In the long run, it can change sometimes to some extent, but normally the fixed overheads remain constant irrespective of the quantity of production. Now, say for a small example, it's not that I am going to explain this in detail. If you have a factory which is on rent, and if your fixed rent payment for a month is 500,000, the capacity of the factory is say 100,000, you start manufacturing just one item a unit. Your fixed overheads per month remains the same, and you keep increasing your quantity of production from being 1 unit to 10,000 units, till the fixed production overheads will remain the same, the rent remains the same. And if you increase it from 10,000 to 100,000 items, till it remains the same. So it is not commensurate with the production capacity, with the production volume changes. So now when you allocate fixed overheads to the actual production, you need to be little careful. It's not like you allocating variable overheads. Why? And if the fixed production overheads like the factory rent is 500,000, and if you can accommodate 100,000 items in that factory, the amount of factory overheads or the amount of fixed overheads chargeable to one particular unit, one item of inventory should be how much? 5 rupees. 5 rupees. And if the material cost is 20, labor cost is 15, and variable overheads 10, and the fixed overheads will be 5, so it's going to be how much altogether? 50. And that is what is considered to be the accepted amount of cost when you complete the production of a unit of this nature. What if your production has completely dropped from 100,000 to 1 unit, and then your factory rent is still 500,000? If you decide to allocate fixed overheads based on actual production, then you need to allocate entire 500,000 fixed overhead just to one item of inventory. Is it practical? Is it possible? Not at all. So irrespective of the fluctuations of your quantity of inventories or the items you manufacture, still you need to continue to allocate fixed overheads based on the average production. Average production. This is what you can accommodate in your factory, 100,000 items, and that is what is needed here in this example. The normal production level, that is the average production level, normal production capacity of Anora's manufacturing plant is 320,000 units. 320,000 units per month, and the fixed production overheads are 80 million. Right. So despite of your actual production, you need to still allocate fixed overheads per unit only on the basis of average production level. So how do we take it? 80 million divided by 320. So it's going to be 250 rupees per unit. 250 rupees per unit. Okay. and due to the pandemic the actual production in March 2020 was limited to 176,000. These fixed overheads which are not absorbed into the production, say we kept our factory closed completely over 1 year's time and we would have paid 500,000 rupees in vain just for nothing and no inventory. That is what unabsorbed fixed overheads. Where should it go to? It should go to profit and loss. So the fixed overheads will be allocated based on average production, not on actual production, but in the event of the fixed overheads not being absorbed fully, the unabsorbed amount of fixed overheads need to be taken to profit and loss. So that should be the answer. Let us look at the answer of the examiner. Fixed production overheads of Anora should be allocated based on the normal capacity, that means average production level of the manufacturing plant. Normal capacity is 320 units per month. Fixed production overheads per month is 80 million rupees, hence the fixed production overheads absorption rate is 250 rupees per unit. The amount of fixed overhead allocated to each unit of production is not increased as a consequence of low production or idle plant. Unallocated overheads are recognized as an expense in the period in which they are incurred. In this case, unallocated fixed production overhead cost of 36 million rupees should be recognized as an expenditure in March 2020. Right. Third one, due to physical usage, Anora did not charge depreciation for property, plant and equipment. During the closed down period, the company depreciated PPE using the straight line method. It also did not perform an impairment test to assess the recoverability of the carrying value of PPE as of 31st March 2020. Right within the question is there a part of the answer. Why? The examiner tries to remind you something about what is it. Due to no physical usage, Anora did not charge depreciations of property, plant and equipment during the closed down period. So which is wrong? And there was a traditional fallacy, conventional fallacy, a misunderstanding and a myth that depreciation is like the physical wear and tear based on the usage, and that was good old days. It's outdated now. No. So depreciations will be completely a different concept now. So you need to start depreciating when the asset becomes available for use, and you need to continue to depreciate the asset irrespective of the temporary out of use for a particular temporary period, idling of the assets, and you need to continue to depreciate the asset despite of their idleness, despite of the fact that the assets were out of use temporarily in a particular period. Now, just because the assets have not been used over a particular period due to pandemic situations, the entity has decided not to depreciate. That is wrong. So you need to continue to depreciate the asset. Also, now we know, now since the assets are idling, we learn in LKS 36, idling is an indication of an impairment loss. So you need to, get on your feet and to roll down your sleeves and start conducting the impairment review why the assets may have been impaired due to these reasons like pandemic situations. So you need to continue to depreciate the assets despite of the fact that the assets have not been used for some times, and also the assets idling is an indication of impairments, and you need to conduct the impairment review by 31st March 2020 or as the indications arise. And that has to be the answer for part 3. And let me also read out the answer of the examiner. Property, plant and equipment. Depreciation does not cease when the asset becomes idle or is retired from active use. Unless the asset is fully depreciated, hence depreciations of PPE from 16th March to 2020 to 31st March 2020 needs to be provided. Also, COVID-19 outbreak is a possible indicator for perform an impairment test for PPE as of 31st March 2020. Then number 4, the estimated value of the sales drop during the close down period is 2,420 million rupees for financial year 2021. The resulting estimated contribution loss due to the sales drop is 356 million. The management of the company expects to make a full provision for the estimated contribution in 2019 and 2020. The estimated value of the sales drop during the closed down period is 2,420 million for financial year 2021. The resulting estimated contribution loss due to the sales drop is 356 million. The management of the company expects to make a full provision for the estimated contribution in financial year 2019 and 2020. Now we have to look at LKS 37 for a moment. Now, if you create a provision, you cannot do it just for the sake of doing that, just because you want to create a provisions and you can't create provisions. So, it has to be disciplined enough to recognize provisions only when the required criteria are satisfied. What are the criteria? Make sure that a present obligation is existing as a result of a past event. Make sure that there is a probability of outflowing resources with economic benefits in a settlement of an obligation, and make sure that we can do the best estimate of the required amount of resources needed to settle that obligation. And here what is predominant is not the second and the third criteria. What is predominant here is the existence of a present obligation. A present obligation is existing as a result of a past obligating event. It need not to be just another event. Make sure it has to be an obligating event. If an obligating event has occurred, the entity does not have any practical means of avoiding from that obligations but to settle that in cash or using any other resources. Future operating losses cannot be provided for. Why? Present obligations do not exist. Why? An obligating event has not taken place. How do we know? If an obligating event has taken place, you don't have any other alternative but to settle that in cash or using any other assets, resources in the company. Here you can avoid future operating losses, and you can bring your heart and soul and you can do something which can be a breakthrough, and that will result in you making more money. And you can diversify the business into another new area which you never even thought of diversifying into, and you can start up a newly formed company. I mean, you can diversify it into a new business, and you can canvas your business, or you can even close down the business to avoid the future losses. Then you can avoid it. And you need not to write everything I said. It has to be what? For you to recognize provisions as per case 37, you need to list down the required criteria. You can copy it from the standard book, no problem. So, what prevents you from recognizing a provision here? What prevents you from recognizing a provision here is the absence of present obligations. Why? The event that triggers that present obligation has not taken place, has not occurred still. Why? Because you can avoid from these obligations using so many methods. So then provisions are not permitted, provisions cannot be recognized. Let us look at the answer of the examiner. Provisions shall not be recognized for future operating losses, since future operating losses do not meet the definitions of a liability. However, an expectations of future operating losses is an indication that certain assets of the operations may be impaired. So that is what they have said. So we are moving on to question number 4. Here we go. Hotel PLC is in the process of finalizing its annual financial statements for the year ended 31st March 2021. As the company's business was severely affected by the COVID-19 pandemic, the draft financial statements reflected a net loss for the year compared to a marginal profit in the previous year. The accountant of the company, who is a member of CA Sri Lanka, presented the draft financial statements to the managing director. The managing director informed the accountant that the financial statements cannot be issued reflecting a loss as it directly affects the share price. He asked the accountant to capitalize some expenses of revenue nature which would have otherwise been recognized in the statement of profit or loss. The managing director threatened the accountant and said if the suggested adjustments are not done, the accountant will not be promoted. Required: demonstrate 3 fundamental ethical principles that the accountant would breach if he was to do the adjustments to the financial statements as requested by the managing director. B. Assess the threats to the fundamental ethical principles arising from the above scenario. Right. Now the accountant of this company is a member of CA Sri Lanka, and he has prepared the financial statements and it has been given to the managing director. The managing director is little reluctant to the managing director informed the accountant, and he has informed the accountant that the finance cannot be issued reflecting a loss. The managing director is under the impression that if we issue the financial statements showing a loss, and that will directly affect to the share price, and that's going to be a major issue. So now the managing director is now almost threatening, intimidating to de-recognize some of the expenditure from profit and loss and to capitalize them as if they were assets. And then the managing director is showing something, look, if you will not be an obedient accountant under me, I have to rethink of your promotions. I have to rethink of your promotions, and you need to be an obedient accountant under me, and then only I will think positively of your promotions. What do we call it? It is like intimidation. Intimidation. Now let us look at the ethical challenges. Ethical challenges. We learn couple of ethical principles in our curriculum. You know, you need to be honest in your work. We call it integrity. And you need to be, have this quality and the principle of objectivity. What do you mean by being what do you mean by objectivity? Objectivity is where your practice, you've been a member of CA Sri Lanka, your practice will not be influenced by anyone else, and your practice has to be based on SLFR research. and it has to be completely an independent exercise, independent practice, and you should not slanting, you should not slant to particular category, and you should not prepare the financial statements in a way that you favor to a particular party, and you need to satisfy the information requirements of all the stakeholders identified in particular. Now, if you will be biased just to satisfy the requirements of a particular group of parties, then objectivity will be challenged, and that will be objectivity will be a clear breach. Then you are supposed to do your work based on SLFR research, and if you just forget about and ignore SLFR research and to start acting according to the requirements of the managing director, that will be a clear breach of your professional behavior. And if SLFRS says something, what you do will be completely contradictory and contrary and against the requirements of SLFRS, just because you do it to satisfy your superiors, to be in the good books of your superiors, then no point of you being technically competent. Your professional competency goes in vain, it is of no use. Why you do something directed by your superiors and it's not in accordance with the prescriptions and the requirements of SLFRS. So that again will be a problem. What is it? Your professional competency will be challenged. So those are the fundamental principles, ethical principles rather. Ethical principles. What are these fundamental ethical principles? Integrity. What do you mean by being honest to integrity? If you work without having any self-interest on that work, you are honest. Integrity is there. But maybe you will be compelled to listen to the managing director and to do what he wants you to do because you have a self-interest. What is your promotion? So that my psychological mindsets will compel you to do what your managing director asks you to do. Why? Your mind will be demanding you to get the promotions, and for you to get the promotions, you need to act according to the instructions of the managing director, not in accordance with the pronouncements and the prescriptions of SLFRS. So integrity will be a breach of, integrity will be a complete breach, and now you work not on the basis of the requirements of SLFRS. This is just for the sake of looking after, and this is just for your personal and self-interest to get your promotions. Objectivity. Objectivity means what? Not being influenced by anyone. Not being influenced by, no, you are influenced by the managing director, and you will completely circumvent and change and ignore the requirements and the pronouncement of SLFRS, and you will do only what your managing director requires you to do. So you are under the influence of the managing director, so objectivity has been a clear breach. Professional behavior. You need to prepare the financial statements, that's your prime responsibility, in accordance with the requirements of SLFRS. Now it does not happen. Why? You do it to satisfy one particular party. So your professional behavior is a complete breach. Professional competency. You know SLFRS, you have learned a lot of things over a couple of years. So what is it for? So, all what you learned, your technical knowledge, your competencies, your professional knowledge is of no use now. They all go in vain. Why? You act not in accordance with the requirements of SLFRSS, you act in accordance with the requirements of the managing director. So, once again your professional competencies will be a complete breach. Assess the threats to the fundamental ethical principles arising from the above scenarios. One threat will be self-interest. Your mind is demanding you to listen to the managing director and to do what the managing director requires you to do. Though it is not your heart, though it is not your integrity, your mind and your soul, your psychology, your mindsets will be demanding on you not to do anything else but to act according to the requirements of managing director. Why? Your promotions. Intimidate. Now the managing director is doing the intimidation. Why? He is threatening now, and he is threatening and getting you to do some work. Intimidate. Now that again is another threat. If that is happening within your business organization, you are under a threat. You are under a threat, and that is what you need to say in your answer. Let us look at the answers given by the examiner. Integrity. If the accountant was to do such an adjustment, he is not straightforward and honest in preparing financial statements. Objectivity. Accepting MD's suggestion will also show lack of objectivity. It is the requirement that an accountant should not allow bias, conflict of interest, or the influence others to override professional judgment. Professional behavior. Accepting to do such adjustments will result in the accountant not complying with the Code of Ethics and Sri Lanka Accounting Standards, which in turn results in discrediting the profession. Professional competence and due care. As such adjustments are not in compliance with Sri Lanka Accounting Standards, he has not maintained professional knowledge and skill at that level required. Part B, the answer, self-interest, a financial or other interest. In this case, accountant's promotions will inappropriately influence the accountant's judgments or behavior. Intimidation. The accountant will be deterred from acting objectively because of pressures, including attempts to exercise undue influence over the accountant by the managing director. So that is what you need to write in your answers to get full marks for question number 4. Question number 4, and that has been completely from ethics. It has been from ethics. So we completed discussing question number 1, MCQs, and we completed discussing question number 2, and this is we completed discussing question number 3, and we also completed discussing question number 4. So we are moving to question number 5. Question number 5 has been from the ratio analysis, and apparently the question is a very straightforward question, not so difficult, not so complicated. Win-Win Private Limited imports tile grout and mortars and sells them through its island-wide distribution channel, which contains on showrooms, distributors, dealers and commission agents. The company has prepared its financial statements for the year ended 31st March 2021, and the following amounts have been extracted from the financial statements. Win-Win 2021, 2019-20, industry average 2021, trade and average trade receivables, average trade payables, average inventory, revenue, cost of sales. Calculate 4 key ratios from the information provided for Win-Win Private Limited for both years and the industry average. Discuss 2 possible explanations for the movements in each ratio calculated in part A above. So, you are freedom to decide, you are independent to decide what ratios you would calculate, but with the information given you need to be little restrictive, because we have been given average receivables, average payables, average inventories, revenue, cost of sales, and you cannot think of calculating ROCE, because for us to calculate ROCE, adequate information is not given, and you cannot think of calculating, say, assets turnover ratio while the information is not given. So, you need to decide the type of ratios to be calculated, so within the boundaries, and you need to be within that limited information given. So, now we can calculate average trade receivable collection period, we can calculate average trade payable settlement period, we can calculate inventory holding period, and we can also calculate revenue is given, cost of sales is given. So, thereby you can calculate the gross profit, and then you can also calculate GP margin. So, that is what I feel we can calculate with the information, with the type of information given, and if you feel that you can calculate anything else, you are permitted, but I do not think other than that anything else will be possible. And then you need to see the movements. Movements can be ups and downs, there can be increases, decreases, and you need to discuss what do you think can be the possible reasons for changes of receivable collection period, what do you think can be the reasons for payable settlement period, and you need to think of possible reasons and you need to give them, and that is the second part of the question. So, in the first part you need to first complete the calculations. Let me start with the calculations first. Calculate 4 key ratios from the information provided for Win-Win Private Limited for both years, and industry average. Let me take 2021, then 2019, industry average, average collection period, say average debtors are divided by credit sales into 365. Now, you can calculate averages only for 1 year. For 2021, you can take averages because you have the closing balance and the opening balances, but then for 2019 year, you are not in a position to determine averages. Why? We have the closing figure, but the opening figure is not given. So, that you might feel so if you just by heart the formula and try to calculate. Please do not do that. By hearting does not work at all. It does not serve your purpose at the exam, not at all. So, please, you need to adjust yourself to the circumstances, and if we are given only the closing balance, so let us be happy with what is given, and even that is enough information for us to complete the calculation. So, let us take the year end balance as the average. You can do it, no issue. Average, anyway averages are given, I am sorry, averages are given. The figures given are the averages. The examiner seems to be so kind hearted and he has done part of the calculations or by himself. Averages are given, so the given figures are the averages. 82 debtors, revenue is 1410 into 365. 82 divided by 1410 into 365. That is 21.2 days. So don't put 10 decimals, but let me put it. You can round it off. You can make it 22 days. 76 divided by 1260 into 365. That is 22 days. 22. Industry average 235 divided by 2530 into 365, 33.9. So let me put it as 34 days. 34 days. Average trade payables, say average settlement period. Average settlement period. Creditors, average creditors divided by credit purchases into 365. Creditors 95 for 2120 credit purchases, and now you are not given the credit purchases. Instead, we can take cost of sales, no problems. That is very important at the exam. So don't stick to some hard and fast, especially in this ratio calculations. If you by hearted the formulas and came for the exam, you will be definitely obviously in a problem, because you start looking for that by hearted formula which has got deep rooted down into your mind, and then if you can't find it, you become desperate and lot of issues will be there. So better not to by heart the formulas and come. You need to understand the concepts, and then you can do easily the calculations. So 95 trade payables divided by cost of sales 630 into 365. 95 by 630 into 365. It is 55 days, 55.03. Previous year, average trade payable 63 divided by cost of sales 580 into 365. 63 divided by 580 into 365. 39.6 days. 39.6 days. Next one, industry average. Average trade payables 345 divided by cost of sales 1390 into 365. That is 90.5. 90.5 days. 345 divided by 1390 into 365. Inventory holding period. Average inventory holding period. Average inventories divided by cost of sales into 365. Average inventories are given 125, cost of sales given, cost of sales 630 into 365. Average inventories for the previous year 148 divided by cost of sales 580 into 365. Industry, average inventory given 450 divided by cost of sales 1390 into 365. 125 divided by 630 into 365, 72.4 days. Last year 148 divided by 580 into 365. 148 divided by 580 into 365. 93 days. 93 days. Industry average 450 divided by 1390 into 365. 118 days. 118 days. Then GP margin is also possible. GP margin, gross profit divided by sales into 100. Gross profit has to be first calculated here. Revenue is given 1410 minus 630. Gross profit is 780 divided by sales 1410. 1410 into 100. Last year 1260 minus 580, 680 divided by 1260 into 100. Industry average 2530 minus 1390, 1140 divided by 2530 into 100. 780 divided by 1410 into 100, 55.3. 680 divided by 1260 into 100, 53.9. 1140 divided by 2530 into 100, 45.05. Right. Let's see the calculations done by the examiner. The examiner has also calculated receivable period 21 days, last year 22 days, industry 34 days, fine. Settlement period and inventory holding period. Inventory holding period 72 days. Settlement period 55 days, 39.6 days and 90.5 days. Inventory holding 72 days, 93.14 days, 118 days. GP margin 55.32% and 53.97%. Industry average 45.06%. So then for the movements you need to give some explanations. Now if you see first debtors collection period, the movements are insignificant, but still you need to observe the movements. It has been 22 days last year, this year 21.2 days, and average collection period for the industry 34 days. Now the movement is because it looks like the entity has accelerated the collection from the customers, expedited their processes of collecting money from the customers. Why? And you should be able to sit and think, why does what makes a company, what makes an organization accelerate their collection process, and why are we collecting money from the customers? And you can think of some simple reasons, or you can think of some complicated reasons as well. Now the company would have thought of shifting towards more cash sales rather than on credit sales. Their cash sales would have been much more bigger this time than the credit sales. That is also possible if you have taken the total sales. I mean, without taking the credit sales, we have taken the total sales for the calculations. It can happen. Oh, another simple reason that you can think of is that we would have offered some generous discounting schemes to the customers. You guys can say, settle us in advance, you can settle us early and you get this benefit, discounts. You will get some discounts, and the discounts would have been some, attractive discounts, for the customers, and then that wouldn't have been sometimes available in the company, and that wouldn't have been given to the customers before. Or else we would have implemented some controls in the company, in the debt collecting department. So now we, without being reactive, we thought of being proactive, and we work earlier than we used to before. We have started being proactive now. So now, without you waiting for someone come and to pinpoint something, you start working on your own. So maybe we give the credit term of 30 days, but even before 30 days, you are sending some reminders to the customers. Look, your set amount is due on this such and such date, and please be good enough to make the settlements. So there would have been some new control systems in your collecting department. Even that would have been a reason sometimes this year. And there would have been some changes in your customer portfolio. Maybe earlier our customers were stronger and they were negotiating some extended credit period with the business. But now the customers are like new, and they are not as strong as the previous set of customers, and they are not strong enough to negotiate very long extended credit period from the company. So anyway, from the company's viewpoint, that seems to be some positive. There seems to be some positive signs, because if you can collect your cash balance earlier than we used to, the cash position of the company becomes healthier. So a lot of issues can be resolved, because you need not to go from pillar to post asking money from banks to banks, and you can minimize and reduce down your finance costs. That's a different discussion, and you need to explain the reasons why the ratio has moved and it has become favorable from the company's viewpoint. So what are these points now? Maybe because we motivated cash sales this time, and we would have offered some generous discounts to the customers. So the customers were little persuasive this time. They were little enthusiastic to make the settlements a little earlier. And maybe sometimes the customers, class of the customers would have been different, and the customers are not strong enough to negotiate extended credit period. So those are the reasons for the movement in the collection period from 22 days to 21 days in the current year. Settlement period, it was 39 and now it is 55. It has got extended significantly by almost like 16 days, if you see, 16 days. And once again, from the company's viewpoint, that seems to be little okay, but you need to get down into the details to see why and what repercussions it will have on how does it impact on the company's business relationships. Sometimes it will damage the business relationships with the suppliers, and the suppliers will otherwise decide not to continue to supply goods and materials, and we'll discuss. Creditors, maybe because you started moving more from cash purchases to credit purchases, you are motivating more credit purchases during the current year. Or as I said before, under collection period, we are now changing our suppliers, and the previous suppliers were very demanding and appealing, and they wanted us to make the payment strictly on time, and we were little fed up with the previous suppliers, and we wanted kind of a flexibility, and so we have shifted from the previous suppliers to the new set of suppliers, and they were very lenient and flexible, and they have given us extended credit period. Maybe sometimes we are ignoring completely the settlement part of the suppliers, and we are keen for the collection from the customers, but settlement to the suppliers, that particular part would have been completely ignored, and no one supervises. When no one supervises, the payment and the procedures, the systems would have been messed up, and they all must be in a haywire, so nobody supervises, and that would have been due to negligences sometimes. Or else the suppliers would have thought of giving us certain concessions because they want to continue with our business relationships, and they would have thought of giving us some extended credit period. And the examiner has given indications obtaining better credit terms, more focused on credit purchases, poor supervisions, and similar indications have been given by the examiner also. And for debtors, the examiner has given some reasons: new credit customers that are less powerful, similar thing, and customers may be taking advantage of available prompt payment discounts. Win-win may be taking a more proactive approach. Fine. Almost similar things. Then we are moving on to discuss the reasons why the inventory holding period is changing from 93 days to 72.4 days. And it has, like now in the industry average, industry averages are completely different compared to the ratios of the company being concerned win-win private limited. Now holding period, it was 93 days, now in the current year 72.4 days. Now the company's business strategy would have been sometimes different during the current year. Maybe they were focusing more on less demanding products. Now they are moving from selling less demanding products to more demanding products. Now say daily consumables are the products that are demanded the most in a business organizations, and that's what they are focusing more these times, and that part has been little ignored and skipped. Or else we are implementing very attractive and captivating advertising, and maybe sometimes we are offering discounts. Maybe sometimes customer loyalty programs would have been in place, and the customer loyalty programs, the customers towards the end of the year would be redeeming their points, and they are purchasing the goods from the company. And sometimes we, without keeping the inventories with us, we will order from our suppliers only when we receive order from our customers. So the orders from our customers will be matched with the supplies from our suppliers, and we will place the orders to our suppliers as and when we are receiving orders from our customers. That is also a possible reason. So anyway, it would have been due to attractive advertising and promotional campaign. So the customers are really enthusiastic and energetic to purchase goods from us, and the inventory would have been, turnover has increased unprecedentedly, and this has not been experienced ever in the business. Or else we are focusing more on more demanding products rather than on less demanding products. Or else our systems of trading would have been different. We are now ordering the goods from our suppliers only when our customers place orders with us. And those would have been some possible reasons for the changes. Anyway, turnover has increased, and that is why the holding period has come down. Gross profit margin. See the GP margin. it was 53.9, it's almost 54%, now 55.3. And that was an improvement of like 1.4%, 1.4%. Now we know, so basically you can change the GP margin for three reasons only. Either you need to change your selling price, or you need to change your cost of sales, or you need to change the sales mix of the company. And to change the cost of sales, you can think of many reasons, like if you import goods and sell, maybe the import tax systems would have been turned out to be favorable to the company. Now import taxes are less, so your cost of sales will be less. Or if you still import goods and sell, maybe your rupee appreciation. If rupee is appreciated, then once again your cost of sales will be down, cost of sales will be reduced. Or maybe sometimes certain expenses categorized under cost of sales would have been categorized otherwise under administration expenses to the profit and loss, and the cost of sales will come down, and then the GP margin increases. Or there would have been some increases in selling prices, or there would have been changes in the sales mix, and those are some possible reasons for the changes of GP margin. And let's see what the examiner has given. Gross profit margin may be improved due to the following: more sales in high margin items, less seasonal and promotional discounts, implementing successful cost management initiatives. So some similar reasons have been given. Anyway, it's a very simple, I can't say simple, but it's a manageable questions within the given period. I wish we get similar questions even this time in your paper CL2, so that you can score more, and that is very fair and a reasonable question, so that you can finish it quickly and it's manageable within the given time period.